moving on to the next session, which looks at the great talent crunch through the lens of two investors. A very interesting conversation. Oliver Rippel and partners set up Asia Capital to help Southeast Asian entrepreneurs build a new generation of unicorns, while Chris Hameter is the co-founder of Thayer Ventures, which is an early stage venture capital firm with a strategic focus on the travel and transportation industry. Now, these two investors have one thing in common. They are betting big on the next generation hospitality companies. Let's find out why and how they view the talent crunch. Thank you. Thank you, Oliver and Chris, for joining us, and Pete for being my co-captain in this discussion. So given this is the Bridge series, I found this slide by Asia Partners interesting in its comparison between Southeast Asia and the US. So Oliver, from Asia Partners, what was the key message you wanted to convey with this comparison?
Yeah, thank you. First of all, thanks for having me again, and it's always a pleasure to engage with you on these wonderful discussions on Southeast Asia and what's happening in the region. So what we try to portray is that actually Southeast Asia has a lot of potential, and potential always starts from the macro perspective, right? And there is no better way to describe the macro than to look at the monthly active humans that you have in a certain region or in a certain country. So undoubtedly Southeast Asia has close to 10% of humanity, right? So that's what you see on the right-hand side of the column. But what we also felt was interesting, that if you compare Southeast Asia, to the US, that despite Southeast Asia being so much almost double in terms of population, if you just look at the top cities, fairly comparable to the United States. So from that perspective, we actually have even higher potential in the future, right, for further urbanization, which comes with all kinds of opportunities within certain products and services, and also tech-enabled product and services that come with it.
Right. So clearly, Asia Partners was set up on the belief of this massive potential that you see, in this comparison that you've given. And it's also set up on the belief of Southeast Asia's golden age. You call it the golden age. And you've predicted that there will be 20 plus more billion-dollar value tech companies from the region by 2029. That's your prediction. Given what's happened the last 2 years, do you still hold on to that belief, Oliver?
Yeah, this is an interesting one. We actually got this one wrong, but differently wrong, right? So we thought there's an opportunity for multi-billion-dollar plus companies in technology in the region to go from roughly 15 to 35, so an increase of 20 within a decade. So what we've seen in the past 2 years alone was actually an increase of 24 additional companies. So that number already has blown way past that decade target that we had previously. And again, we believe that it's due to this golden age fact, right? That Southeast Asia has hit just the right zone of affluence, about a decade behind China, a decade ahead of India, and even more importantly, we are seeing now lots of interesting talent, lots of interesting entrepreneurs, having access to funding, having access to overall, further talent ecosystems, having the playbooks from China and from other parts of the world, and really developing interesting businesses across the region, not only single country focused, but multi-country focused. So in a way, okay, the entrepreneurs have surprised us. They have done this faster than we anticipated.
Okay. Pete?
Great. Yes. Let's bring Chris into this conversation. So Chris, as you reflect back on your original investment thesis at Thayer Ventures, it was always based around travel growing faster than GDP. And in addition to that, travel being very underinvested in technology. And if you can pull up the slide, Jerry, you were dead right for the decade between 2010 and 2019. So this is some Focusrite research that shows the industry growing from just over $1 trillion in 2010 to just under 1.5 trillion in 2019. And from a GDP perspective, we went from about 9.5% to 10.5% over the decade, as far as travel being a percentage of GDP. But then came 2020. So has your investment strategy changed at all in the past couple of years, or are you still just doubling down on your original thesis?
We're doubling down on our original thesis for sure. I think that if anything, we've accelerated our deployment, and we've certainly increased our enthusiasm. I think if you were able to take this slide and move it left and show the forecast for the next 7 to 10 years, you're looking at a multi-trillion-dollar complex global value chain that's likely to enjoy 15 to 20% compounded annual growth as it recovers, made up by a collection of massive incumbents who found themselves largely caught flat-footed and lacking agility when the pandemic hit. So suddenly, we've gone from this world that was always historically resistant to the adoption of technology and change to a world that is just absolutely fundamentally focused on tech as a must-have, no longer just a nice-to-have. So, frankly, the pandemic has accelerated the pace of innovation, and it certainly has brought in more investment and enthusiasm in companies that are showing that they've figured out the next thing.
Right. That leads us nicely to the next question, because I'm going to ask Oliver, right? Given that COVID has accelerated tech everywhere, right? And in Southeast Asia, you said by 10 years, what are you more concerned at this stage to fuel that growth? Is it capital scarcity or is it talent scarcity? What are you most concerned about?
Yeah, that's an excellent question. And you have to dig a bit deeper, because you can be very happy with progress on both. But in certain areas, you still have some catching up to do. So if you talk about capital scarcity, what's undoubtedly positive in the region is that we have now, and this is thanks to a great venture capital ecosystem, we have now actually enough capital at the early stages of capital formation. So if you are an entrepreneur, you're looking for like your Series A, Series B type of funding, the $1, $5, $10 million check to get your company going. Usually at that point to demonstrate product market fit, to really expand into, for example, one territory. There is capital there, and that hasn't been the case 10 years ago. So that's a great development. Also, if you are a company that is already very well established, maybe thinking about a near-term IPO, at that late stage of private equity, there's also sufficient capital, and that can be local, regional capital from overseas. So once you have demonstrated strong proof points, then you usually also are fine. Where there's still scarcity from a capital perspective is in that middle zone. So if you are an entrepreneur, you want to raise $30 million, you want to, with that $30 million, go from maybe 1 or 2 markets to 3 to 6 markets in the region, etc. And you may not be 1 to 2 years away from an IPO, but more like 3 to 5 years away from an IPO. There's still a scarcity. So we quantify this as about 1.1 billion of growth equity at that $20 to $100 million check size range that's missing each year in Southeast Asia, if you were to compare it to China and GDP adjusted. So that's a concern, and Asia Partners and other growth equity investors are trying to fill that. On the talent side, we've also come a long way. So where previously, for example, tech talent was fairly concentrated in, let's say, Singapore and Vietnam, we've seen especially Indonesia come through quite nicely in the past year or two, surpassing, for example, Singapore in terms of like that raw engineering talent. But there's still pockets where talent is scarce, and that could be very specialized functions, like a head of sales, or a chief product officer, or a chief people officer, or that CFO that can ultimately take you public.
So Oliver, we'll get into the talent scarcity specifically later, but let's focus on hospitality. And I think Pete, you have a question to ask of Chris specific to hospitality, right?
Yeah. So as we think about the great talent crunch, which is what we're talking about today, obviously hospitality has been one of the segments that's been hit the hardest. So does this support your conviction, Chris, in the value of lodging tech, or are we stretching below that critical threshold of just not having enough staff?
Both. I mean, from a perspective of a hospitality delivery, we are definitely below that threshold of delivering service again. I mean, those of us that have been on the road, I mean, we see it day in and day out, right? The restaurants are closed, the services are shut down, guests are frustrated, especially in the accommodations world, and it's going to take some time to get people back to work. But that said, I think that the great crunch of labor in hospitality generally is part of the problem that the industry ran into when the pandemic hit and found itself lacking productivity. And I think a huge push for tech innovations and even business model innovations is coming from this really desperate need to sort of rejigger the model so it's less dependent on labor, at least in non-guest facing labor.
Yeah, and from a more practical front, so companies like Opti in your portfolio, are they finding it more difficult to sell into hotel groups because there's just been such a reorganization of responsibility? Obviously a tech platform that helps optimize operations, but is it more challenging from the sales front to get into the hotels?
It's actually the opposite. I found that at least at the larger groups pre-pandemic, there was a lot of sort of stagnation by committee, right? A lot of these large organizations had global cross-functional teams evaluating software technology for housekeeping, and we're on track to deliver their recommendations in 2 years. Right? So that's not exactly what we would consider agility. So those teams got decimated by COVID, furloughed, organizations got flattened, people got moved aside, and there's been more of a willingness to iterate and experiment and test. And that has enabled good software companies to get a bite at the apple. And if they're delivering ROI and they can show it, there's sort of an eager, enthusiasm to share it among their peers, and these companies grow. So it's actually a really good time to be a productivity-driven software business in the hospitality and travel space.
Yeah, I think we're seeing the same trend in Southeast Asia for sure, right, Oliver? It's similar trend. Also facing labor crunch in places like Singapore. Now you invested in RedDoorz, which has done remarkably well through the pandemic. Now, what tech trends are you most excited about, in how it will transform hospitality from a labor and service standpoint?
Yeah, so very good point. So I mean, what we are excited about, and that was a strong reason why we invested in RedDoorz in the first place. It's kind of like a new age. We call it like a new age hospitality company. So it's asset light. So it doesn't have to run hotels themselves. You don't have to incur rental and labor costs right at the property level. But they're very good in building brands and generating demand. So you're going into this sort of like franchise/partnership model, with hotel partners, where you are helping them to increase and optimize, revenue and profitability, and you're going into this, very entrenched, partnerships, with them. So it's almost like, if you take a step back, it's like a software as a service plus marketplace, type of model. So you're not only providing technology, but you're also helping the hotel leverage their technology to optimize a demand and ultimately revenue and profit generation. So we find that interesting. It's not sort of like just a naked solution, just digitizing for the sake of digitizing. It's actually saying like, hey, we can do better, and we can do things more efficiently at the same time.
Okay. So Chris, we had Chris Nassetta, Hilton CEO, on one of our virtual meetings last year, and he suggested that labor is probably his single biggest issue, and it's forcing some operational model changes that's creating a higher margin business for him. So is this just public CEO speak, or do you see these operational models changing? And Oliver touched on it a little bit with RedDoorz, and you've got some portfolio businesses that are doing similar. So is there truly an operational shift that's happened?
Yeah, I mean, I think that's a really important point and a good question. And by the way, I love RedDoorz. We know those guys. I've been to Jakarta and met with the team. We almost participated in the last financing, but we'll find a way to work together, Oliver, because that's a great company. No, I think Chris is absolutely right. Chris is spot on. Part of the problem in our industry is inertia, right? And through 2019, the hospitality delivery model hasn't changed much since the 1950s. Let's face it, the back office is full of people doing sort of nonsensical things like night audits and on-site accounting. And, but no one has bothered to change that because RevPAR has been growing successfully at a pace that's outpaced the growth in labor cost. So the model hasn't changed. Now we're suddenly so disrupted by all of these, changes and forces that the model has to change. Otherwise, the big elephant in the room, which by the way are the people that own the real estate, are going to start kicking out management companies left, right, and center and trying to figure out how to do it themselves, because at some point, they have to monetize their real estate. So what I think this is doing is it's enabling a completely new think about what is the delivery of hospitality. And what we've been saying for years is that, accommodations, where people sleep when they're not at home, is this big amorphous cloud ranging from, the early days of Airbnb and sleeping on someone's couch all the way to the Marriott Marquis in downtown Washington, D.C., and a range of things in between that. And we're seeing innovations like Sonder, who are delivering sort of professionalized, branded, short-term rental experiences, to companies like Lifehouse, who have really used a complete vertical technology stack to rethink the delivery of hospitality in the small hotel real estate form factor in ways that can triple NOI just by removing labor that's non-guest facing. So you see these models, and frankly, I think for the big brands, the opportunity for them to rethink the way they deliver hospitality, to take out some of that labor overhead, will result in greater margin and greater delivery to the real estate owners in the end of the day. Because frankly, I think travelers are coming back, and they're coming back with a force, certainly leisure travelers. And, as long as they still have the same experience and perceived value, I think we will see RevPAR growing again to record levels.
Right. So, it's really a rebound and recovery and the convergence of tech, and then, talent issues forcing tech innovation, right? So Oliver, getting back to what we're talking about, the talent issue, right? So in your 2022 rebound and recovery report, which I found fascinating, a lot of data, you shared some data on the Southeast Asia chessboard, right? And that looks at relevant technical talent. So which markets will face the biggest challenge, you think, accessing the relevant technical talent to fuel growth in Southeast Asia?
Yeah, so I think the chessboard says it all, right? So we have good technical talent in places like Singapore, Vietnam, and now also increasingly Indonesia, which wasn't always the case. So that's a great development. And the other markets still have some catching up to do. And what has happened is that a lot of companies that are focusing on Southeast Asia, they were often supplementing technical talent from within the region with technical talent from India, China, elsewhere. So the companies are creative around going around that issue on the technical talent. Right. Overall, the trajectory is positive, but we still have some catching up to do, especially if you compare Southeast Asia to, for example, China or India.
Well, especially, I guess, during COVID, where everybody's working remote, and now we're talking about hybrid workplaces, the ability to hire from anywhere. So even though Singapore is like a commercial capital, companies here now have access to talent everywhere, including the US, right? I mean, Pete, that's your next question from Chris.
It is. Yeah. It's a good point. And here in the West, there's definitely a big developer, a deficiency in developer talent. And it's, I suppose, dubbed the great developer drought is what I've heard it called. And companies like Amazon Web Services and Google are offering massive salaries and signing bonuses and benefits. So Chris, how have you been supporting your portfolio on the talent front, and what types of strategies are they putting into place to recruit and retain talent?
Well, I mean, I think that first of all, we're seeing, of course, more and more offshore development talent being incorporated permanently into teams. And I think we've now gotten to a place where that's seamless, right? And very effective, and it works well. I also think, look, Google and Facebook can pay as much as they want to. It ain't a startup. Startup environments are different, and they're fun, and they're dynamic, and there's equity involved, which is, people like skin in the game. And so good startups with velocity still manage to attract talent. And frankly, it's the fundamental job of the CEO to onboard that talent and build his or her team over time. So, we do what we can to support, but in the end of the day, that is a fundamental job of the founder.
Right. And Oliver, do you think in Southeast Asia, where we have a younger workforce, and tech is relatively new, right? And do you feel that talent here still wants to gravitate towards the companies like Facebook or Google, or the TikToks versus working for a startup, which is really, really hard grinding work?
Yeah, good point. So a few years ago, that clearly there was a strong, gravitational pull to these more established, global brands. But we have had some good success more recently of local and regional role model companies that went all the way to become public companies and to really put Southeast Asia on the map. I mean, Sea is a good example, but also more recently companies like Bukalapak and Grab and hopefully more to come. So that actually has made it easier to see yourself becoming part of sort of like an emerging startup ecosystem that not sort of like just not going to go anywhere, but going to go all the way, right? To become ultimately a public company, ringing that bell right on the New York Stock Exchange. So we definitely see, all the reasons that Chris mentioned, right? In terms of, working on cutting edge stuff, having real ownership, and making sort of like difference in terms of your line of sight activity, where people are shifting more towards the more startup-ish kind of like ecosystem, away from the more established players.
Right. So let's go to the next slide, which really shows how Singapore, is the commercial capital of Asia, but from the standpoint of regional executive roles. But then now with the ability to really hire from anywhere, I think startups really now have the luxury, and the ability, as we were saying, to just hire from anywhere. Kind of levels the playing field a little bit, And so now, Pete, why don't let's shift to investment strategies now and talk about what's happening with their funds and what they're doing.
Yeah. So Chris, you for years, Thayer was primarily focused on seed stage and Series A. And then you jumped a little bit later stage and were involved in the SPAC game in 2021 and brought Inspirato public last year, which has bucked the trend of underperforming returns for companies using this instrument to access the public markets. So I've got 3 questions for you. First off, why the shift from later stage or into later stage? Second, what's your secret? And third, will you launch any more SPACs, or is the SPAC craze cooled for good?
Great question. So, look, first of all, you have to remember that we are a sector-focused investment platform, right? Thayer Ventures is focused exclusively on travel tech and mobility. And so, within that sector, we are more flexible with respect to stage, and we've done some later stage investing in the category. Now, during the pandemic, it became very clear to us that the disruption that our industry was facing would create an opportunity for those large private companies that had seen some resilience through the pandemic and had strong tailwinds coming out of it to get on the offensive, right? To take advantage of the moment and get out there and win. So we looked at a variety of ways to play that thesis, and we decided to do it via a SPAC, principally because we felt it was a vehicle to get companies to the public markets, to access capital, to lower their overall cost of capital, and again, get on the offense. We always approached it as a financing event, not a liquidity event. We always approached it as a long-term relationship with the company that we decided to merge with, and as fundamental, operators within the sector that we focus. So our board came from the industry. Our DNA is the industry. We felt that differentiated us from many of the sort of transaction-oriented SPACs that were out there. And it helped us, by having a deep focus in this industry. I think we had a fundamental sense of who was playing the right music, and we found Inspirato, and we loved it. Right, this is a luxury traveler, which is a very interesting category, super powerful and resilient. It's sort of a supply side driven story. It's got this velvet rope subscription process that you have to be inside the velvet rope in order to have access to the supply. So it kind of has this fundamental flywheel effect, which gives it a competitive advantage globally. So all the fundamental things were there, and we just supported what we knew would work and have stayed with it. The markets have responded very positively, although it is early days. I mean, float is still thin, and there's a lot of other reasons fundamentally why the stock maybe is up or not, but still fundamentally, I'm a huge long-term and solid believer in the company. So I would say, from a secret sauce perspective, I would say anybody in the game of playing, with companies and investing, even in the world of SPACs, is you kind of have to have a sense for, your investing thesis. You just can't be out there looking for a transaction. And unfortunately, I think because SPACs became so hot, a lot of teams onboarded and established SPACs simply looking for a transaction, and they really didn't care if it was a pharma company or a transportation company. They just wanted to try to find a company to take public and make money. That's going to turn out to be a failed strategy. Those companies that have been specific and operator centric, I think, will succeed. Now, the SPAC market is under a ton of pressure, but I don't think it's dead forever. In fact, I really do think that as a path to public, it's a good one for some companies, not for all. And as this sort of period shakes out, I think you will see the serial issuers come again, do more deals, and it'll become an alternative to a traditional IPO. Look, the traditional path to IPO is still, it's slow, it's opaque, it just doesn't work fundamentally for every company that has an opportunity to get to the public market. So we intend to stay around the hoop and continue to do good work there.
Right. So clearly, Chris has very, very strong views on the SPAC space, and I'm sure Oliver has too. But I want to focus, Oliver, on your fund, which is you are in online video ad tech, car marketplace, and online travel, as well as online health, right? Those are the areas that you stated in your report. Any further appetite for travel as it recovers? And if you listen to Chris, how passionate he is about specific travel investments. What's your appetite for travel right now as it recovers?
So we have huge appetite for travel, and a lot of that appetite can be fulfilled through our RedDoorz investment, right? Which was the first investment that we did, through Asia Partners, and we think that there's tremendous opportunity, right, from a further regional expansion, as well as also thinking about further brands in the market that where RedDoorz can offer the same sort of like software plus marketplace / demand generation type of service. But having said that, travel is one of the large subsectors of tech and tech-enabled businesses, and budget hospitality is just one of those use cases within travel. So ultimately, we are open. We at any given time we look at 20 to 30 subsectors of tech within Southeast Asia, where there is a strong Southeast Asia anchoring, and if we see interesting companies go through the ranks and are in this interesting middle zone of too large for venture capital, too small for late stage PE, then as a growth equity focused investor, we would be looking at those companies. So we fully agree that that travel rebound is going to happen strongly in the region. That the use cases which right now during the pandemic were mainly around domestic travel use cases will further again be strongly complemented by inbound use cases, which were a bit less of a focus during the pandemic. But markets like Thailand, like Vietnam, like Philippines, like Indonesia, we're going to shine again from an inbound perspective, right? So there's no doubt about it in our minds.
Mm-hmm. So now is both of your chances to make one prediction. So I'm going to phrase the question this way. What will be the largest opportunity that we will look back upon 10 years from now and say, wow, the pandemic provided fertile ground for X? Chris, let's start with you.
Fertile ground for the total restructuring and rethink of accommodations real estate. I think that the old days of thinking about accommodations real estate as a hotel model only are over. I think multifamily is becoming a hybrid asset class, and I think that there will be more, including single family homes and luxury villas. I think the whole world of sort of hospitality real estate and the monetization of hospitality real estate is going to be the biggest fundamental shift happening pre-pandemic, but accelerated by the pandemic.
Oliver, how about you?
I think this whole trend of becoming more of nomads, right? Digital nomads, etc., and to basically move away from short-term travel to sort of like travel that will require me to almost like relocate temporarily to a new location. I think this is going to be huge, right? So we see this already with our entrepreneurs, that the ones that we are backing at Asia Partners, right? That it's much less about going in and out of countries, like doing the usual kind of like triple Excel of hitting three countries within 24 hours. It's much more to be co-located with the team on the ground for sometimes weeks or even months, right? And to become part of that fabric. And what that means in terms of the accommodation space, what that means in terms of like how to organize and structure my travel, where to stay, what kind of services I need while I'm almost like becoming a resident for that few weeks or months in that other location. I think we have barely scratched the surface on that one. So that we think be much more prevalent. Yeah.
So Pete, if I could answer the question and wrap up the session, I think that the pandemic provided fertile ground for collaboration. So between WIT and Focusrite, as we've seen, and I think we're going to see collaboration between Thayer Ventures and Capital Asia Partners. And they're going to collaborate before they come to WIT Singapore, October 3rd to 5th, and have the F1 weekend before that. And it will provide fertile ground for a different way of traveling for our customers and for ourselves. So very exciting future, and how to turn this great talent crunch, right, into the great renewal for our industry. So thank you so much, Chris and Oliver, for joining, and Pete for being my co-captain. Thank you so much.
Thank you.
Thank you, Susan.
Thank you.